The Reserve Bank held the cash rate once again. More banks hiked mortgage interest rates. Household debt rose, and our latest research showed that more than 800,000 households across Australia are experiencing mortgage stress. Welcome to the latest edition of the Property Imperative. Hi, I'm Martin North, the Principal of Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 8th of July 2017. HSBC said the housing bubble fears were overblown. At a national level, a key reason for rising housing prices has been housing undersupply, Chief Economist Paul Bloxham wrote in a research report on Thursday, and suggested that a significant fall in Australian housing prices, as occurred in the USA and in Spain during the global financial crisis, is unlikely here in Australia. But data from CoreLogic showed whilst home prices rose in the last quarter, auction volumes fell and housing affordability deteriorated. The national price to income ratio was recorded at 7.3 compared to 7.2 a year earlier and 6.1 a decade ago. It would have taken 1.5 years of gross annual household income for a deposit nationally at the end of March, and that's compared with 1.4 years last year and 1.2 years a decade ago. The discounted variable mortgage rate for owner-occupiers stood at 4.55%, and an average mortgage required 38.9% of a household's income. New data from the RBA showed that the household debt-to-income ratio rose to a high of 190.4. Households are more in debt than they've ever been. And the main question has to be, can it all be repaid down the track before mortgage interest rates rise, and they rise so high that more get into difficulty? Our June mortgage stress results showed that across the nation, more than 810,000 households are estimated to now be in mortgage stress, which is up from 794,000 last month. And 29,000 of these are in severe stress. This equates to 25.4% of households, which is up from 24.8% last month. We also estimate that nearly 55,000 households risk mortgage default in the next 12 months. The main drivers are rising mortgage rates and living costs, whilst real incomes continue to fall and underemployment is on the rise. This is a deadly combination and is touching households across the country, not just in the mortgage belts. We analyse household cash flow based on real incomes and outgoings and mortgage repayments. Households are stressed when income does not cover ongoing costs, rather than identifying a set proportion of income, such as 30%, going on the mortgage. Stressed households are less likely to spend at the shops, which acts as a drag anchor on future potential growth. The number of households impacted are economically significant now, especially as household debt continues to climb to new record levels. Census data shows that home ownership has continued to fall amongst younger Australians. Only 36% of people aged 25 to 29 said they owned their home outright or with a mortgage, and that's likely the lowest level since at least the 1960s. Home ownership for the next age group, that's 30 to 34, also declined to 49%, which is likely another record low. Overall, inequality in Australia is rising between those who have property and those who do not. Australia has prominent examples of economic policies that disproportionately benefit the upper middle class, such as the capital gains tax discount and superannuation tax incentives. We also have a geographically concentrated income distribution, with the rich living in neighbourhoods with other rich people. The poor are also more likely to live in close proximity to people who share their disadvantage. There were major changes to mortgage rates and underwriting standards again this week, with many more banks following the herd by lifting rates for interest-only borrowers, especially those who are property investors, whilst making small downward movements to principal and interest loan rates, especially for those fortunate to have lower loan-to-value ratios. NAB announced that it will start automatically rejecting customers who want to borrow a high multiple of their income and only pay interest on their home loan. And that's amid concerns over the growing risks created by rising household indebtedness. Whilst NAB already calculates loan-to-income ratios when assessing loans, it has not previously used the metric to determine whether or not a customer gets a loan. And such a blanket approach is unusual in the industry in Australia. But we have maintained for some time that loan-to-income ratios is an important measure. It should be in use much more widely in Australia, as it is a much better indicator of rising risk than loan-to-value ratios, and that's especially true in a rising market. Several more banks tweaked their mortgage rates this week. Virgin Money, for example, increased its variable and fixed rates for new owner-occupied loans with LVRs of over 90% by 35 basis points or 0.35%. And it increased its standard variable rates for owner-occupied and investment interest online loans by 25 basis points. Auswide Bank announced an increase to their reference rates for investment home loans and lines of credit of 25 basis points. And this will result in a new standard variable rate of 6.1%. They blamed funding pressures and regulatory limits on investment and interest-only lending. ING Direct was another that changed their reference rates. For owner-occupied borrowers, the principal and interest rate will decrease by 5 basis points. But for owner-occupied borrowers, interest-only rates will increase by 20 basis points, and investor borrowers on interest-only loans will cop a 35 basis point rise. They're also encouraging borrowers to switch to principal and interest loans. Bendigo Bank lifted variable interest rates by 30 basis points for existing owner-occupied interest-only customers, and 40 basis points for existing investment interest-only customers. They also lifted business loan rates, with new business interest-only variable rates up by 40 to 80 basis points, and fixed interest-only rates increasing by 10 basis points or more. On the other hand, new business investment principal and interest variable rates will decrease by 15 basis points, and fixed principal and interest rates decrease by 30 basis points. So the rebalancing continues. The RBA held the official cash rate at 1.5% for the 10th time on Tuesday. It hasn't moved since a 25 basis point cut in August 2016. But analysis shows that the gap between the RBA rate and the standard rate that the bank quotes to mortgage borrowers is around the widest in 20 years. The banks did not pass on the full benefits of the RBA record low rates in order to offset their costs and to prop up their profits. Last year, there was a massive race to the bottom in terms of mortgage discounting to try to gain volume and share. So many banks dented their margins in the process, but now they've got the perfect cover thanks to APRA's regulatory intervention. And so we expect to see mortgage rates continuing to grind higher, particularly for investors and for anyone on interest-only loans. This will simply lead to more mortgage stress down the track, whilst the banks rebuild their profit margins. It's another example of inequality in action. And that's the property imperative to the 8th of July. Do check back next week, and thanks for watching.